Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Brian, great to be able to catch up with you. It's been a while, but my goodness, it's so great to see you. So it's hard to believe, how much I miss everybody. I'm sure.
Likewise, Catherine. It's good to be back and digging into the media issues, albeit in a two-dimensional format this time. But yeah, looking forward to it.
Yeah, well, thank you. Let's get your top-down view, your macro view right now. Of course, there's been so many fits and starts as it relates to the market valuations, overheated, concerns with respect to too much stimulus. How are you looking at the pullback that we're experiencing?
Yeah, I guess, Catherine, the way we think of it is, just kind of a normal pause and what we still see as an ongoing cyclical bull market. And wow, what a cyclical bull market it's been. It's only about 14 months old, but it has been the strongest cyclical recovery off of a bear market we've seen in modern history. But we think there's more gas in the tank. And, as the cliche goes, markets climb a wall of worry. And we can talk about some of the things that are worrying markets, but we see a very, very, very robust economic backdrop, and we can talk about some of the reasons why we believe that will continue. But it's game on for risk assets and for stock markets, in our view. Certainly throughout the remainder of this calendar year and probably longer.
Okay, but let's unpack that a little bit, just in terms of the concerns out there that seem to be winning the day.
Well, so I guess the number one sky is falling argument that we hear is, outcry from the bond markets. Obviously, bond yields have backed up quite a lot, call it 100 basis points on 10-year bonds in Canada and similar in the US off of, historic generational lows that we saw last year. So, if we just sort of took that snippet of data out of context, we might see that as cause for alarm. But the thing we have to remember is the level of interest rates. So they're still very, very low. They're still, if you looked at a 40-year graph, they're still kind of near the x-axis asymptote almost. So we don't see this level of interest rates as being, something that's going to break the bull market. And then the other thing about interest rates is people often make the mistake of thinking, well, there's just one interest rate and it's the government risk-free rate. But, you do need to think more broadly about credit conditions. And we see credit is wide open. Bank lending standards are not particularly tight. The high yield bond market is wide open. Spreads are pretty narrow, and the investment grade market, even more accommodating. So credit is flowing.
And Brian, when we think about the U.S. jobs numbers that missed expectations last Friday, which was, I don't know, it was almost so hard to believe how far off the consensus estimates were. I don't know how that quite happened. But what was the market interpretation of that, do you think? And what's the right interpretation?
I think the market, by and large, shrugged it off. Normally, if you saw a 500,000 job miss on a payroll print, which, remember, is empirically the number one most market-moving economic data release each and every month, you would see blood in the streets and probably a 2, 3, 4% pullback on that day in the market. So we didn't see that. And we didn't see much more than kind of flickering on the tape in the bond market either. So I think the market interpreted it correctly, which is it's sort of normal random statistical variation around what is, a 12 plus month enduring trend of job creation, or maybe more appropriately said, recovery of lost jobs.
And so, when I looked at the market as well, in terms of the market really shrugging it off, and in many ways it's because, the risk on assets or equity market, if that's what we're looking at, which we are basically saying, well, look, the Fed's going to have your back for even longer. They're going to continue to stimulate the economy and make sure that we actually do see a recovery. At the same time, though, we are hearing from, very well-known money managers, Druckenmiller today, indicating, well, and many people have said this or have concerns that the Fed is going to stimulate too much.
Well, that's a legitimate risk. And so I think that's why you're seeing thematically these so-called reflation trades outperforming value over growth, commodities over tech, and so on. And I think the risk is that you've got kind of 2 feet on the gas pedal. So, we needed the Fed last year because we didn't have fiscal stimulus. Now we have a new administration in the US. We have red ink as far as the eye can see in Canada here as well, which poses longer term kicking the can down the road problems of all of its own. But arguably the need for aggressive, unprecedented, or unconventional monetary policy is somewhat alleviated by the multi-trillion-dollar stimulus in the US and the hundreds of billion of stimulus that we're still seeing here in Canada, even while the job market has recovered most of the jobs that were lost last year. But the thing about inflation is it is a lagging indicator of monetary policy. And I think what the Fed is telling us, and the Bank of Canada is towing the line as well, is that we're willing to tolerate an economy that runs a bit hot, more so than we would have been in the past. So, I think investors are correctly positioning for that by buying and bidding up the shares of, pro-reflationary themes.
Mm-hmm. And we're going to talk a little bit about lumber today as well. Let's talk, just to kind of go on the thematic side of your bullish case, at least for the remainder of this year, and it sounds like even into 2022. What are the key drivers of that?
Well, I think it's broad-based economic growth. Some of the indicators that I would point you to would be job recovery. So 14 million jobs created plus in the last 12 months in the US. Canada has had job growth in 9 of the last 12 months. Admittedly, we had some job losses last month given the more stringent lockdown and social distancing measures, but the underlying trend is intact. Then we've got very robust household incomes, household savings rates, retail sales, for instance, in Canada are back to year-end 2019 levels. Housing starts, arguably the biggest ticket item in any household's consumption basket are, screaming hot and are at all-time highs in many parts of this country. So, I think you're seeing a lot of consumer confidence, seeing a lot of corporate confidence, big ticket M&A, for instance, Rogers Shaw, Kansas City Rail, CN Rail, and so on and so forth. So I just think there's overwhelming evidence that we've got a very strong economic backdrop here. And it's going to be hard for kind of niggling around the edges on interest rates to derail that in the near and medium term.
Are you at all concerned, though, when I think about what could rock the Canadian housing market? And I've had obviously, so many conversations about this over the past 10 years, that's for sure. But I think one of the key items or metrics would be what happens to one's job. If you don't have your job, the likelihood of you being able to pay your mortgage or continue to pay it, there's a risk there. It's almost more so important to take a look at the jobs picture versus the interest rate picture, perhaps, as it relates to the Canadian housing market. So what's your interpretation of the Canadian jobs data?
Well, first of all, to the basic premise of the question, yeah, I couldn't agree more. Whatever effect interest rates are going to have on affordability and mortgage payments is overwhelmed 10 to 1 or more by, the binary risk of 1-0 job or no job. If your income goes to zero, it gets pretty hard to pay your mortgage. And so what we did see last year is a combination of things. First of all, OSFI, the Office of the Superintendent of Financial Institutions that regulates the banks, gave kind of credit leniency and capital leniency to the banks, if they voluntarily deferred delinquent mortgage payments, which they did. And the overwhelming majority of those mortgage payments are now, up to date. And then secondly, the federal government, and to a lesser extent, the provincial governments de facto socialized the loan losses that would otherwise have been eaten by the banks and their shareholders via, multi-tens of billions, if not north of $100 billion of transfer payments and relief payments to households in the corporate sector. So, that shored up that risk. And so now we've kind of gotten past that most dire phase of risk because jobs are coming back. So, jobs are still always and everywhere going to be a risk case by case to a household making their mortgage payments, but systemically, we're through the phase of job losses or the worst of it. So I don't think that's the big risk. What could be a bigger risk is some of these so-called macro-prudential policies that have been floated, trial balloons, like eliminating the exemption on capital gains on principal real estate. That would be bad policy, and that would be a political suicide, I think. But, so I don't necessarily think we get there, but those are sort of, end of the tail or black swan kind of risk to the housing bull market, which in some form or another has been ongoing since the mid 1990s. It's been incredible.
It has been incredible. It's and then obviously exacerbated to the upside even more so with the pandemic. And I think too, everybody's wanting or focused much more on owning hard assets, just given the amount of stimulus from the various central bankers around the world. So that's another tailwind to the housing market anywhere.
Yeah, I mean, I think what we're seeing in housing, and actually it's timely that we're talking about this. We actually wrote a blog piece on our website, which your viewers are welcome to look up at goodreid.com. It's actually about lumber specifically. And it actually calls out an anecdote that we thought was kind of relevant in thinking about lumber and housing. And what that was is Brookfield Asset Management, who I know you're very, very familiar with, one of Canada's biggest and most capable, notoriously long-term value-centric investors, sold almost the entirety of their stake in West Fraser Timber, a stake that they have held through a series of predecessor companies since at least the mid-1990s, and where they've made out like bandits on it. And so, the long and the short of it is, I think Brookfield probably concurs with our view, is that what we're seeing in housing is a pandemic-induced step change in demand that's one-time in nature, because housing is a durable good. It's not like bread or milk or t-shirts. You buy one or you build a deck on your house. If it's lumber we're talking about, and then it lasts for many years. We don't think we're seeing a slope change, which is lasting and permanent, that kind of is going to be a forever move of people away from the cities and into detached housing. And so in our view, what we're seeing with lumber is kind of manic and is probably the late stages of a blow off top in a frothy market, and in a liquid market to that contract.
So does that mean though that, yes, you would be in agreement of selling any of your timber holdings, timber stocks, A, but B, what does it mean in terms of people out there trying to build a deck and they can't get the lumber, they're paying up 200%?
Well, yeah, I mean, I guess we sort of said tongue in cheek in this blog entry that the aspiring backyard projector or home rental enthusiast might do well to emulate one of Canada's largest and most long-term minded value-centric investors, and perhaps defer that backyard rental project or building the addition on the house. Because, yeah, I mean, by some accounts, Catherine, the rise in lumber prices, and this is US data, is adding tens and tens of thousands of dollars to the cost of building a detached home. So, last time we checked, lumber is still a renewable resource. So, and lumber is traded in the $200 to $500 range since at least the mid 1980s. So now at $1,400, $1,500, it's 3 times the highest ever prior cyclical peak. So, we just don't see that it's sustainable. And so if you can wait, you probably should wait. And then to the more immediate and actionable question from our perspective as active managers, do you sell your lumber stocks? We don't own any, so we've got nothing to sell. But if we own them, yes, we would be hitting those bids hard.
And just on the fundamental front, in terms of, it's so interesting to see or note that the price range for lumber, was a tight range for decades, and to see it double essentially. Other than demand, was there anything, or what was on the supply side that would really have such a impetus to cause that price to go up?
Well, I think there's a couple of things. There's, obviously we can probably all agree that timber is not really a scarce resource. It's not like gold or diamonds. There's lots of forests. You take your chainsaw, you cut it down. What is scarce though is sawmill capacity. And so actually post the sale of Brookfield selling the West Fraser timber shares, West Fraser said, we're going to fire up 5 new sawmills. So, you're going to see a supply response. But what is throttling supply right now, we think, is a combination of things. One would be physical distancing restrictions. So, this is sort of a high density work environment. So if you're trying to keep people safe and not getting sick, it's hard to have your full labor force in a sawmill. So there's that. And then you've got supply chain bottlenecks. Lumber is big and bulky. Some of it is seaborne. A lot of it is railborne, truckborne. But it doesn't matter how it moves. There are bottlenecks throughout the transportation supply chains, and it's just hard to get stuff shipped. So, and then finally, seasonality, right? This is the time of year when housing starts are coming on fast and furious, and all these backyard projects get undertaken. So it's kind of a perfect storm of a one-time step change in demand colliding with temporary cyclical supply constraints and seasonality.
Okay, so bottom line, if you own lumber stocks, sell them. And if you want to build, wait.
That's, I mean, in my case, if you want to build, you hire someone to build, unless you want to cut off your fingers or toes. But yeah, timing's not great if you're procuring lumber. It's expensive when you think the price will come down.
Okay. One of the other aspects I know that you're focusing on is what we heard from the federal government in terms of the budget. What's your view in terms of continuing to stimulate the economy? Is it too much? Is it needed? Is the Bank of Canada incorrect in thinking that they're going to be able to really taper the bond buying program?
Yeah, I don't have a strong view on whether the Bank of Canada is going to succeed in this taper that they've already started in baby steps without kind of triggering a hiccup. We saw the taper tantrums in the last cycle when the Fed took the foot off the gas with quantitative easing. So, we might get to a point where, the bond market blinks and calls the Bank of Canada's bluff. But then, more directly to the federal budget, the deficits are massive. Certainly it comes as no surprise to anyone that the 2020-21 deficit was going to be epic. And in fact, it's bigger than all deficits accumulated by every government prior to this current Trudeau administration. So yeah, big numbers. What is maybe a bit more surprising and disconcerting is the fact that the taps are still wide open here in 2021-22. I don't have the exact numbers at hand, but I think the deficit is forecast to be, 160, 170 billion dollars. And so when the US is throwing around trillions, we seem relatively frugal by comparison. But for context, the biggest deficit Canada ever ran prior to these past 2 years was 50 billion in the great financial crisis. And even deficits of 20 or 30 billion were causing some on the right side of the political spectrum, some consternation during the first few years of the Trudeau administration. So some of the spending is temporary pandemic relief, but some of it is structural. And then there's other bigger, loftier, leftier ideas being floated out there, like universal basic income, universal subsidized daycare, and who knows what else. So people that were around living in Canada, investing in Canada in the 1990s will remember that eventually somebody's got to pay the bill. And anybody who runs a household budget or balances a checkbook kind of knows this intuitively. The federal government hasn't really woken up and smelled the coffee. And so the money is being spent like there's no tomorrow. And the irony of it all is it probably wasn't necessary because many of us are getting vaccinated, and some of this pent-up demand, especially in the service sector, is going to get unleashed naturally. And secondly, we could have piggybacked or coattailed on the huge multi-trillion-dollar stimulus that the US is doing, given the trade linkages between our two economies. So, I think this is virtue signaling, it's vote buying, it's not fiscally prudent, and at some point it's got to stop. Whether it's forced by an election or the government kind of wakes up and comes to their own senses, I don't know how it happens, but can't continue.
Well, and hopefully people wake up, and when I say people, all ages, but certainly young people. I mean, in the 90s, I just graduated from university and it was tough to get a job. I mean, when you start to see the need to pull back on spending, I mean, corporations are front and center on that point, and they're not going to be hiring. And young people need to know that, when you start to pay the piper back, the job market is not easy.
Well, and it's a twofold problem, I think, Catherine, because, the stimulus, government procurement and government hiring, that feeds kind of directly into the job market, either by hiring government employees or putting contracts out for tender. The private sector wins and they need to staff up. But the other aspect of it is a bit more insidious and has a longer tail to it. And that's the fact that, you know, when you do take your foot off the gas and come somewhere, you know, in closer range to balancing the budget, there's only really two ways to do it. You cut spending, and there's no appetite anywhere by any Western government to really do that in any meaningful way, or you raise taxes. And so corporations pay a lot of tax and individuals pay a lot of tax. And so if you raise corporate tax rates, that's a disincentive to capital investment, which we've had a mass exodus of already in Canada for tax and competitiveness and regulatory and red tape reasons already for the last 5 or 6 years. And then if you start taxing capital gains, as has been floated, like you just make it a hostile place for investment and hiring and job creation. And it's more likely than not that the deficit gets brought to heel by tax increases than it is by spending cuts in our assessment, certainly under this government.
And under this government, and that's key. People need to know. So, Brian, having said all of that, let's now talk a little bit about your investment strategy. And I mean, obviously you said that you do believe that we are still in a bull market, but from a geographic perspective, how do you want to allocate capital, given what you just almost said about Canada and the incredible amount of spending here?
Well, so we are somewhat specialist investment managers at Goodreid. We have specific expertise in Canadian equities. That's my bailiwick. I manage our Canadian equity mandates. My colleague Gordon Reid, who you know, runs a U.S. large and small cap mandate. And then several of us collectively co-manage fixed income and preferred shares. So what we did do in our balanced mandates, which comprise the vast overwhelming majority of our clients, is we reduced US slightly and upweighted Canada at the start of the year. And the thinking was synchronized global growth and fiscal stimulus that we thought was likely on both sides of the border advantage Canada because it is a more pro-cyclical economy. And it's, you know, the composition of the public markets, the TSX composite versus the S&P 500 is more weighted to cyclicals and value stocks and less weighted to, you know, secular growers and growth stocks. So, you know, we think that's going to be validated nicely this year. And so far it's been working.
Yeah, it's been a great call. You know, you can even just look at the Canadian dollar and that tells you the whole story in terms of the trade or the investment approach that you just described. What do you think though, or what would Gordon think or your team think about some of those go-go growth stories in the United States right now that have been under pressure because of their valuation metrics? And again, that kind of rotation out of growth. But, you know, some of the names like a Google, like an Apple, they seem to be the industry leaders and can kind of manage or march through that rotation trade.
And they can, and we're still exposed to them. You know, we don't really make bold all in or all out kind of bets. You know, we don't short things and we don't zero weight important sectors in the market. So it's really kind of more flavoring portfolios and finessing them around the edges. So, you know, as good disciplined risk managers, we take profits on things that appreciate rapidly and grow at outsized concentration in the portfolio. We do that in Canada. We do it in the US. And, you know, I won't put words in Gordon's mouth, but having owned Apple for 10 plus years and having I don't know how many bagger on it, you know, we've been disciplined in trimming it. And then this year, reallocating capital into more pro-cyclical areas of the market. And of course, we've been doing the same thing in Canada. To take advantage of what we think is going to be thematic leadership, given the macro backdrop that we're seeing strong evidence of this year in this cycle.
So let's talk then about some of the Canadian focused areas for you. What kind of trades have you been doing or shifting allocations, whether it's you know, into financials, trimming financials, telecom, growth by acquisition? What are you looking at these days?
So yeah, again, sort of back to the idea that we don't kind of go all in or all out. You know, the way I've always thought of the Canadian market is in three broad buckets, and you want to at all times have exposure to all of them, and at sometimes more of one and less of the other. But those areas are defensive / interest sensitive. The other is growth, secular growth specifically, which is a small pond to fish from in Canada, but we think we run a pretty concentrated high conviction portfolio and find the best of the breed there. And the other is value and cyclicals. So we've been down weighting and de-emphasizing the interest sensitive and defensive corner of the portfolio and upweighting and increasing our exposure to the value and cyclical trades in the portfolio. And, to give two examples, I guess, of trades we made this year, we've sold Enbridge from our total return mandates, although we continue to own it in an institutional income seeking mandate because it does have a 7% dividend yield. We've sold Dollarama in our total return mandates, and we bought, Transcontinental Publishing and Packaging Company. We bought NFI, which is the bus manufacturer. So those are kind of examples where there's elements of value and cyclicality to them. And in the case of NFI, there's also a more structural and secular growth thesis and shift ongoing. And then we don't want to forsake the financials either. We have a bit of an outlier pick in an income-seeking mandate, and that would be Laurentian Bank, which is not well loved by Bay Street, but we like it and own it, although it's not in our total return mandates.
And why is it unloved, and why do you like it?
So, in the banking sector, Laurentian Bank really is the bank that exemplifies value/turnaround opportunity. It's always been, as you'll remember, I'm sure, to an even greater extent than CIBC, the bank most likely to bump into a sharp object. And that's been the case for many, many decades. And so we've kind of not owned it and overlooked it. I mean, I can think of scarce instances throughout my 25-year career where I've owned it anywhere where I've been managing money, but we bought it late last year in this income mandate. And so were it not for the fact that they had been publicly embarrassed by the mortgage underwriting irregularities a couple of years ago, were it not for the fact that they had taken the drastic, rarely precedented step of cutting their dividend 50%. The last bank that did that was National Bank, and you and I were in primary school or kindergarten when that happened. Like, it just doesn't happen. And then finally, had they not taken the drastic step of ousting their long tenured CEO and hiring an outsider. I mean, I can't ever remember a Canadian bank doing this. I would have probably been in the same camp as most of the analysts on Bay Street who rate the stock hold or sell. But I think the board explicitly acknowledges by hiring an outsider that there is a need for a cultural change and a structural change, and we're going to get it done.
Okay. The other name that you mentioned briefly is Enbridge. Let's talk a little bit about that and pipeline and politics. I'm not sure how any of this plays out.
Yeah, I mean, obviously we've got a looming deadline for Enbridge, which is probably dominating the news headlines today. The Michigan governor has threatened illegally and arbitrarily to shut down Line 5, which supplies Michigan and Ontario and Quebec with gas and oil and propane and jet fuel for Pearson Airport. So, I don't know what she's trying to do unless she wants Michigan or to freeze in the dark. But yeah, we sold this stock from our total return mandates a few months ago. Not really reflecting the fact that we thought it was, poised for a collapse, but just recognizing that there's an opportunity cost to owning a low beta defensive play, a high yielder, when there's other better valued stocks with better growth prospects this year. We do continue to own it for income in that institutional account because of the 7% yield, which we think is safe and well covered. But Enbridge has kind of gone ex-growth. Like, their dividend increase in December, and they increased their dividend annually, was a paltry 3%. And so that's off the boil of 8, 9, 10% that they've been doing in recent years, and way off the 5-year compound rate of 12%. So, when you have a stock that goes ex-growth and that doesn't trade at an undemanding multiple, it's still 12 times enterprise value to EBITDA, still 17 times earnings, and it's growing at 3% a year. We can find stocks at 10 times earnings growing 30% this year. So, there's that opportunity cost. And the root cause of it really is that the way pipelines and utilities grow is by deploying capital. And we have a very hostile environment, especially in Canada, to deploying capital in any capacity. And now that's mimicked in the United States, the Biden administration and the Green New Deal, pulling of the Keystone permit. So if you can't put capital to work, it's going to be very difficult to sustain that dividend growth. And this is, it's a business competitive issue for a strategically important energy infrastructure asset. If you want to build a pipeline, ask Enbridge, ask TransCanada. You got to convene a focus group of every migrating salmon, bird, and butterfly, and conduct a survey of every blade of grass in the path of the pipeline. And so, capital just doesn't want to be hung out to dry for 10 years waiting to get the green light.
So if Line 5 is in fact shut down, and as you point out, the governor of Michigan illegally shutting it down, and that is because it is under federal jurisdiction, correct me if I'm wrong, what do you think that might mean to Canadians and people living in Ontario and Quebec as it relates to their energy bill? I mean, like, when are people going to kind of wake up and understand that we actually do need pipelines? But also, what are you concerned at all that it might be a shock to the economy?
Well, yeah, it will. I mean, there's workarounds, but I mean, there's a reason why we build pipelines and we don't ship crude by rail where we don't have to, and least of all by truck. I mean, we saw what happened in Lac Mégantic in Quebec 7 or 8 years ago with crude by rail. It's dangerous. It's also not cost efficient, and it's even less so when you got to move it by truck. But the demand is going to be there. You're not going to switch off your barbecue this summer. Neither am I. We need propane. In Michigan, they need it even more. They heat their homes with it in northern Michigan. And if we ever get airplanes off the ground, those pipelines, via the Sarnia refineries, bring the jet fuel to Pearson Airport. So, this is going to be not just a Bay Street issue, but a Main Street issue, and you will feel it at the pump. The workaround, and Suncor, which we own, has talked about, an alternative pipeline coming up through the U.S. Northeast and into their Montreal refinery. And, there's workarounds, but they're expensive, and there's going to be supply shortages. And, as much as people who live in the cities and kind of want to paint themselves in greenwashing, say, well, don't build pipelines. Well, tell us that in December when you're freezing in the dark. Yeah.
And the cost, and even anybody who's excited about getting on a plane one day, I mean, that ticket's not going to be $400 or $500. It's going to be $1,500.
Yeah. I mean, I think this is an issue that is of national importance, and it's an issue where the federal government should be taking strong leadership at the highest levels and averting this, and, getting the governor of Michigan to respect the law and the treaties that have been signed between our two countries.
Mm-hmm. Well, until then, we'll wait and see what happens over the next couple of days, Brian. That's for sure. But then also, to your point, I mean, yeah, it's not going to be Wall Street, Bay Street. It's going to be a Main Street issue. I mean, it already is, but hopefully people start to understand that. And interestingly, to your point on Enbridge and thinking back to Lac Mégantic, I mean, I was on air. I can't remember the year now that was, but it was a long time ago. But it's fresh in our minds and our memories. Just when you think about crude by rail, and what a tragedy it was, and we need to remember that. On the investment front, where do you stand on the rail stocks? Obviously, there's a bidding war going on.
Yeah, so we own CN Railway. We've owned it for several years. We didn't necessarily foresee that, first of all, CP would bid for Kansas City Southern, let alone that CN would jump into the ring and up the ante. But our thesis, I guess, on CN Rail is this is a long-lived cornerstone piece of infrastructure that is very difficult to disrupt technologically. Unless and until Jeff Bezos finds a way of bringing a drone with 100 tons of potash or grain from Manitoba to the port, that rail is going to be, that iron will be in the ground, and there'll be things rolling down those tracks 100 years from now. I think the best kind of proof point of that, or testament to it, is up until, the largest shareholder in CN Rail is Cascade Investment, which is Bill Gates' endowment and foundation. And that's relevant because the time horizon for endowment or foundation is forever. So now Cascade owns a little bit less and Melinda Gates owns a little bit more, but nevertheless, I think the point is made that foundations invest for the long term, forever, arguably, and the fact that they're the largest shareholder of CN is very telling. And so we like CN because it's a compounder. The shares since the IPO in 1995 have generated a compound annual return of 21%. It's hard to fathom what that does over 26 years, but I did the math before we got on the air. I can't do it in my head. It is a cumulative total shareholder return of 12,000% for this company. So it's a great asset. It's economically sensitive. And they were a pioneer in precision railroading. They're a leader in technology with automated track inspections. And Kansas City Southern, if successful, will expand their already excellent footprint further down into Mexico at a time when trade tensions are coming off the boil with Biden in the office and Trump and his walls gone.
Brian, when we think about the markets as well, and it's interesting when you point out the 12,000% return for CN, for viewers and listeners, when you see these markets act a little bit more on the volatile side, sometimes it's hard to stick with the winners. So what's your advice when you talked a little bit about trimming positions? What's your calculation for trimming positions?
Yeah, I guess, to put some numbers around it, our Canadian portfolio, which is where I spend the majority of my time, it's a concentrated high conviction portfolio. We try and diversify it by theme in those three buckets I spoke about earlier, and by sector, and by specific catalysts. But, it's 20 stocks. And so the default is to sort of equally weight those stocks. And so the rough kind of line in the sand where we will feel a stock is carrying an undue concentration risk in the portfolio is if it approaches a 10% weighting in the portfolio. So if you have multi-baggers and year after year after year after year secular winners, you find that you're taking profits, every couple of years just to take some risk and concentration off the table. And because if you don't, after 26 years, your diversified Canadian equity portfolio is basically a CN rail portfolio, right? It's 98% CN and 2% little bits and pieces of everything else.
Understood. Brian, just before we wrap it up, these weren't two areas that we were really going to get into depth in, but I just do want your view in terms of the bank stocks and the telecom stocks. You indicated that, you're rotating more into that cyclical area of the market and away from the interest rate sensitive areas of the market. So what does that mean for the telecom stocks as an example?
Yeah, so in our total return mandates, we don't own any of the telcos. We own a couple of them in the income-oriented mandate. But the reason why we don't own them in the total return mandates is because they're not growing at a compelling pace relative to some of the other opportunities we see out there. They're good ballast in a portfolio, and they proved that last year during the recession. Some of their businesses are very difficult to interrupt with business cycles. Namely the demand for cell phone service, although not roaming fees last year, and the demand for reliable broadband internet. Whereas others like sports and media and entertainment are very cyclical and expose some vulnerability. But, overall, they're decent ballast in the portfolio, and there will come a time when we own them again in total return mandates, but this isn't the year for them. The banks are a different kind of a beast. The banks, we think, are all-season cornerstones of our Canadian portfolio. And so we own three of them in our Canadian portfolios, and we see them as a combination of income and growth, right? Because they pay 3 to 5% dividends, depending on when you buy them. And the basic growth algorithm is most of them aspire to and generally achieve a high single-digit earnings growth rate and a commensurate growth rate in their dividend through a cycle. Right, so they didn't last year, and this year we think there's some unique tailwinds that they're going to have at their back. One of which is they're lapping easy comparisons. So they provisioned heavily for credit losses last year and prudently. Little could they have foreseen that the government would basically socialize all the losses that they would have otherwise experienced. So some of those provisions are going to prove to be unduly conservative. So they'll take that back into income, or at the very least, they won't up them this year. And then secondly, net interest income with a rising interest rate structure and a steepening of the yield curve, that advantages their net interest income lines. And then alongside that, they've got the stalwart fee-based businesses like capital markets, which are roaring this year with big ticket M&A going on. The frenzy in retail trading advantages their discount brokerage operations. And the general rise in markets advantages their wealth management operations, which collect fees on assets.
And so, Brian, which ones do you own?
So we own Royal, we own TD, and we own Scotia. And we think those are best of breed players. And to be clear, Laurentian is not a best of breed player. And that's why we don't own it, with a very long buy and hold view. We own it for income and re-rating in this income mandate, but we don't own it in our total return mandates. But for ones that you want to buy and own for, many, 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 many years, these are your three. We own them for different reasons, but they do a good job of getting us geographical diversification and diversification by line of business. And we think there's like a really good line of sight to a low double-digit return given the current income through the dividend, which, by the way, is likely to be increased this year when OSFI, the regulator, takes off the handcuffs on share buybacks and dividend increases. And then growth, secular growth.
Okay. Just to wrap it up here, Brian, I'm asking everybody this, but what's your latest view on owning cryptocurrencies?
Yeah, we don't own them. Sometimes it's lonely to be wrong and alone, and admittedly, I guess we have been the last number of years. But I think the underlying technology, blockchain, is going to prove to be socially useful. We're seeing good use cases proving that for Ethereum, for instance. But as it relates to Bitcoin specifically, which is, the predominant cryptocurrency, I think this arose out of a mistrust of central authority and commercial banks and government money printing and debasement of currency. But I think people were crying wolf, too early or just incorrectly when quantitative easing was first rolled out in the financial crisis, and perhaps even now. And so, while you have runaway rampant inflation in places like Venezuela and other, less developed countries, you really don't here. But the big knock against Bitcoin is, if you're to see it as money, I have a degree in economics, and the classical economic theory of money is it functions as a unit of account. Bitcoin doesn't. We talk about millionaires and billionaires. We don't talk about hundredaires and thousandaires using Bitcoin as the unit of measure. It functions as a store of value. Bitcoin doesn't do that. It moves 10 or 15% in a week. So purchasing power terms, that's not a store of value. And finally, it doesn't function broadly as a medium of exchange. You can't buy a car with it unless you buy a Tesla. You can't buy a pair of shoes with it. You can't buy Starbucks with it. You can't use it at the restaurant or for your plane ticket. You can use it on the dark web if you want to trade in illicit goods, but broadly speaking, it is not legal tender for all goods, public and private, like a fiat currency is. And I would say probably the existential threat to all private cryptocurrencies that are functioning as money, like Bitcoin, is the emergence of central bank digital currencies, which will enable the benefits of decentralized finance, but will preserve the authority and the sovereignty of governments and central banks as their agents to conduct monetary policy, which, we just don't think they're going to give that up willingly.
Mm-hmm. I hear you. I did step into the Bitcoin world though a while ago after, to your point, not being in it for a number of years, but we'll see how it all evolves and develops. That's for sure. Brian, great to see you and be with you. My goodness, I can't wait for us to all be together again. And I know we will. It'll be sooner than later.
Yeah, looking forward to it. But this has been great catching up and batting these ideas around with you, Catherine. Thanks very much.
Thank you. Well, we'll do it again. I love it. So thanks so much. We'll see you soon.